everybody! You're listening to Accounting Makes Sense, an MJ the Tutor podcast. And I'm your host, MJ. In this podcast, we are focused on helping accounting students all over the world by offering a quick warm-up on various accounting and business topics, hoping to generate bigger discussions and conversations around them. For this episode, I'm going to offer a few tidbits on the MCS Management Case Study for May 2025. The pre-scene has already been out for about a week or two now, so a lot of you students would probably have already started your analysis and going through the information. You may already have some tidbits floating around in your mind. Anyway, just a disclaimer that these tidbits are like clues into the world of the pre-scene company, as well as they are just my own opinion. All of it is really quick and fast intakes of the pre-scene material. I always believe that as you read the pre-scene more and more, you'll also get more insights into it. So let's start off with our background information on this pre-scene. Our company is a company called Tremere, which is a company operating a franchise-based chain of hairdressing salons, and it's based in the fictitious country called Dazland. Our first tidbit to share on this company is the structure of the company. This is really an interesting concept that has been presented on the pre-scene. Not that franchises are anything out of the ordinary. In fact, it's normal business concept in the real world. It's just rare that we get a franchise-based entity. Most of the time, in our pre-scene materials, it's the normal parent-subsidiary relationships. But yeah, anyway, what I wanted to raise here is that this is really a good topic to explore, and you actually need to understand the relationship between the franchisor versus the franchisee. I think it's very easy to assume that franchise salons are just like branches or subsidiaries of Tremere, but that's not really the case. Understanding this difference is key to how Tremere can manage performance and strategy across such a large footprint of locations. What is important to note here is that the franchisee is a separate, independent business run and owned by different people, and they are only connected to our main company, Tremere, via a franchise agreement. But that agreement is really very strict and controlled in a lot of ways. This agreement kinda tethers the business to ours. You'll note on the pre-scene material, a lot of information has been mentioned with regards to what the franchisee is responsible for, what they are agreeing to when they enter a franchise agreement, what the franchisor offers with regards to the success of that franchisee, etc., etc. The franchisee pays an upfront fee and ongoing royalties. Usually this is a percentage of revenue. Operationally though, the franchisor, in this case Tremere, can't just walk into the franchise salon and make operational decisions. It can't set pay rates, it doesn't handle hiring and firing of employees, it doesn't pay the rent, and so on. That's all on the franchisee. I think this relationship or understanding this relationship will be an important concept as you go about in the preparation of your case study. A lot of your answers, decision-making, analysis, and recommendations at the exam will hinge on this understanding of the relationship very clearly. Jumping off from that point and going to our second tidbit, this is on strategy. This comes twofolds for me. One, we needed to understand the franchise relationship because we do have the existence of company-owned salons in terms of Tremere. Tremere still has 40 Tremere pop salons, even though the business has moved primarily to a franchising model. We have 380 pop franchises and 140 Sheen franchises. It's unclear if the owned salons offer strategic value or are legacy assets at this stage. I think in general, they run and feel very much like the other salons carrying the Tremere name, but they are really just remnants of the past strategy. The funny thing about this and why I wanted to highlight it is that if we look at the numbers deeper, you'll see that they're quite profitable. Current year operating profit margin for the company-owned salons are around 38.9%. I excluded marketing and admin expenses on these calculations. It was at 39.6 the previous year, so there has been a slight decline on this percentage. It does kind of show that perhaps it's not going in the direction that we want, although really very slight, right? I can't really say whether it would be a good idea to just divest out of these company-owned salons if they're working for us at the moment. I know a lot can be said about focus and core strength and all that. I don't necessarily think that owning our own businesses, salons, detract us from our core ability, which is hairdressing anyway. But it does give a lot of vibe of maybe being out of focus for the company because you are in the franchising model already. So why not focus your attention there? Another point that I'd like to make with regards to focus on strategy is the existence of two brands in terms of our salons. We have the Pop salons, which are mid-market, and the Sheen salons, which are upmarket. Now, it's not uncommon for companies with products to offer two alternatives, the cheap version and the expensive version. You'll see this a lot in the supermarkets. You'll note a lot of these companies are mostly in beauty and fashion. Some examples are your like Estee Lauder and Clinique, Maybelline and Kiehl's, Coty with CoverGirl and Rimmel. For the guys, if you're not sure what I'm talking about, I can give you Volkswagen and Porsche. Yeah, so we have Tremere running both brands successfully, but we may want to see how it breaks down further on how much each type's or brand's profit margin looks like. Obviously, there is higher profit margin on upmarket brands, but maybe not so much footprint in getting more customers in. The strategy for both brands are different. The tendency for an upmarket brand is more about quality, loyalty, and being elite. And whereas on the mid-market or lower brand, this is more on traffic, quantity, loyalty, but footprint, getting those customers in, as many as you can. Again, nothing wrong with how they're running it at the moment, but it could come up as a bit confusing down the line as to which strategy is the better one. So the third tidbit I'd like to highlight for today is business intelligence and performance data, which we collect and how we can derive value from it. Tremere gathers daily data on average spend, customer retention, revenue per square meters, etc. from all its franchisees via point-of-sale systems. But there's no sign of this being used for deeper insight or action beyond basic monitoring. Could we introduce predictive dashboards to identify franchisees at risk of non-renewal? Are we able to support salon principals with performance benchmarking? I'm sure these might already be in place and we just don't know about them, but just be prepared to touch upon this topic at the exams. You could get a question about BI systems supporting real-time performance analysis, variance tracking, and predictive modeling. Tremere can evolve from just monitoring KPIs to enabling action, so something like supporting underperforming salons before the contract lapse. Better BI use means faster reactions, smarter franchise support, stronger system-wide performance. It also creates a competitive moat. So that's an economic moat, which is a distinct advantage of a company that it has over its competitors, which allows it to protect its market share and profitability. Few competitors actually have this scale of data discipline. So I think, maybe the other three companies with chains of salons, maybe they have them. But in general, a lot of the players in the market don't have this. The last tidbit for today is on apprentices and salon principals. We can't really have a tidbit episode where we don't talk about people management and motivation, especially if our pre-scene material is heavily reliant on its people for its success. Lots of mentions of development of skills and experience, having an academy to train and cultivate future hairdressers, And I think the company believes in continuous development and technology to help its business. So definitely a big topic to cover. I think the issues in the company comes in where Premier invests heavily in training through the academy, training its apprentices, stylists, and salon principals. Yet, there's a gap between central investment and franchisee commitment, since training isn't really contractually required and motivations may vary at the franchisee level. Things to ask is basically, are salon principals incentivized to invest in long term staff development? Do apprentices see a clear path to progression across the franchise system? Some issues could also be needing a deeper analysis with the use of theories like your Hertzberg's two-factor theory or Vroom's expectancy theory, which explains engagement gaps. Franchise businesses often struggle with alignment of values. Premier's goals may not match franchisee behavior, and by linking these training outcomes to incentives, so something like better royalties, terms, better recognition, renewal priority, Premier can strengthen its talent pipeline and protect the brand experience across locations. Something definitely to think about. And that is it for me today. I'm your host, MJ the Tutor. Thank you for joining me today. I hope you've enjoyed this episode and found it helpful. If you did find it helpful, please be sure to subscribe or follow to catch the release of the next episodes. You can also connect with me on various social media like Facebook, Instagram, X, Threads, BlueSky, YouTube, and anything else under the handle MJ the Tutor. You can also visit my website, www.mjthetutor.com. Till next time, ciao for now.